Hi, I'm Jeff Banks from MW Lomax, and this is the Banks Report.
The Banks Report, a commentary by noted property and business tax consultant Jeff Banks. Jeff is not your ordinary accountant and speaks in words and terms that you understand.
In my practice, I help people who are working hard and using property and self-employment to help them reach their financial goals. One of the traps taxpayers will fall into when preparing income tax returns is in relation to travelling expenses. Generally speaking, in order to claim a tax deduction, there has to be a genuine nexus between the incurring of the expense and the gaining and producing of assessable income. If my employer requires me to use my car to go into a client interview outside of my office, one of the traps taxpayers will fall into when preparing income tax returns is in relation to travelling expenses. Generally speaking, in order to claim a tax deduction, there has to be a genuine nexus between the incurring of the expense and the gaining and producing of assessable income. If my employer requires me to use my car to go into a client interview outside of my office, one would generally expect that the use of the car would be tax deductible, and generally, you would be right. There are, of course, exceptions to the rule, and the first one centres around getting to and from work. The ATO take the view that getting to and from work is not a tax deduction. This extrapolates to that if I'm seeing a number of clients in my workday and perhaps I never actually enter the office, that the travel to my first client constitutes a travel to work and as such is not deductible. The same then relates to the last trip of the day. Going from my last client to home is also not a deductible trip. There are even exceptions to this rule when it comes to things like carrying of bulky goods, etc. Where it becomes even more tricky is around travelling to and from my investment property. If I am a landlord looking to inspect a rental property, the expectation would be that travelling to and from that property would be deductible. This is opposed to travelling to and from inspecting a prospective purchase, which by its very nature would be capital in nature and not a tax deduction. Where a rental property is interstate and the purpose of the trip is mixed between inspection of the income producing property and other activities, only the percentage that can be justified as the inspection time would be deductible. Using your own vehicle for what we might term haphazard travel can be claimed by noting the trips in an appropriate vehicle logbook to evidence the distance travelled, and then using an ATO approved rate based on the engine capacity of your particular vehicle to make a claim. Claims of this type need to have a logbook evidence for the entire period of the claim, and the logbook is the evidence. This is opposed to regular use of vehicles, where a 13-week period that justifies the percentage use of a vehicle may be appropriate for travelling expenses claims along with the receipts for the costs. Vehicles and tax deductions are just another of those complex areas that a taxpayer is simply expected to know. In taxation, ignorance is no defence, and the well-prepared taxpayer will ensure that they have appropriate evidence to justify any claims. Should you wish to discuss travelling expenses with your client account manager, please do not hesitate to contact them. Or for those of you who are not MW Lomax clients as yet, by all means drop us a line at deductions@mwlomax.com.au.
The Banks Report is created by Jeff Banks of MW Lomax, a specialist financial services firm offering strategic advice and services you need in property and business, including accounting, taxation, finance, financial planning, risk insurance, superannuation, and business advisory.